Would you pay 8 times more for something you could get cheaper from the exact same company? Every day, thousands of investors do exactly that with one of the oldest emerging markets funds on the planet. And some of them actually have a good reason. EEM is the iShares MSCI Emerging Markets ETF managed by BlackRock, the largest asset manager in the world. It launched back in April of 2003, making it one of the very first funds to give everyday investors one-click access to emerging markets. Today, EEM holds around $30 billion in assets, spread across more than 1,200 stocks. And it has been on a tear lately, returning roughly 32% over the past year. The fund tracks the MSCI Emerging Markets Index. Its biggest holding, by far, is Taiwan Semiconductor at around 15% of the fund. Then comes Samsung Electronics and SK hynix, the Korean memory chip giants, followed by China's Tencent and Alibaba. Add it up, and this fund is really a bet on Asia. China, Taiwan, South Korea, and India make up the bulk of the portfolio. But here's the catch. EEM charges an expense ratio of 0.72%. That is $72 a year on every $10,000 invested. Meanwhile, BlackRock, the same company, offers IEMG, which covers nearly the same market for just 0.09%. That is 8 times cheaper. Same issuer, same corner of the market, radically different price tag. So why does EEM still hold $30 billion? One word: liquidity. EEM is one of the most heavily traded ETFs in the world, with one of the deepest options markets of any international fund. Hedge funds and institutions use it to move millions in and out of emerging markets in seconds. For them, tight trading spreads matter far more than the annual fee. BlackRock never cut the price because its real customers never asked for a discount. Performance-wise, the past year has been strong, powered by the artificial intelligence chip boom in Taiwan and Korea. But zoom out, and emerging markets have lagged the S&P 500 badly over the past decade. And that fee compounds. Over 20 years, it can quietly drain thousands of dollars from your portfolio compared to a cheaper fund tracking the same market. So who is EEM actually for? Short-term traders, options strategists, and institutions who need to get in and out fast. If that is you, the liquidity is worth the price. But if you are a buy-and-hold investor who checks your account once a month, you are paying a premium for a race car that never leaves the garage. One honest caveat: emerging markets are volatile, politically risky, and concentrated in a handful of countries. Whichever fund you choose, this should be a slice of your portfolio, not the whole pie. If this helped you understand what you are really paying for, hit like and subscribe for new ETF breakdowns every week. And tell me in the comments, would you pay 8 times more for liquidity you might never use? EEM or IEMG? I read every answer.